See, that's the other one that's bounced back a little bit. Some of the cement stocks have had a bit of a volatile time. The hope is that margins will recover from here on. ACC is now up close to around 1.5% or thereabouts.
All right. Gati is another one which was up some 14-15%. No news flow on Friday, but now it's pulling back a little bit, 4% or so on Gati. So keep an eye. These are some of the sort of follow through or lack of follow through moves, at least from Friday's session that we had. 112 on the Nifty. Decent start. Manishi Raychaudhuri is with us, Asian Equity Strategist, Equity Cash Asia Pacific at BNP Paribas. Manishi, good to have you with us here. Thank you very much. I think the market probably has given up believing too much in, one-off kind of data which points out to disinflation out of the US, right? That macro theme is still the biggest one this year, 2023. So we got some data points which pointed to that. How durable is this rally that we've seen in the US, this sharp, steep fall in US yields going to be, or you think we'll see a reversal soon enough? Your sense?
I think, this a sharp increase in the equity markets and the fall in yields that we've seen, that's been engendered by, number one, the decline in economic growth and the PMIs, possibly the PMIs, which are a lead indicator. That's possibly been a bigger driver of this expectation of slower growth and consequently the expectation of the Fed becoming less hawkish going forward. That said, there are other data points which point to a different direction, and that's the jobs report. We still have a reasonably low unemployment rate. We still have reasonably high non-farm payroll data points that are coming out of the US. So, and if one combines that with the recent commentary from the Fed, from the December meetings, the minutes, it would appear that the Fed is not done yet. Our base case expectation is about another 75 basis points of rate increase over the first quarter of 2023. And one must also put that together with QT, quantitative tightening, that the Fed is engaging in. Since September, they accelerated the pace of QT. And we think that for the foreseeable time horizon over the next couple of quarters, that's likely to continue. So in a nutshell, we believe that this recent rise will possibly have to give up some of the gains that we have seen across global equity markets. We think that the first quarter, at least, if not the first half, is going to be a period of continued turmoil. We might even see another round of, US dollar appreciation compared to the emerging market currencies. So, and I think in the near term, over the next one quarter or so, we have to tighten our belts and brace for some more volatility in the markets.
All right. By the way, just wanted to mention that the Nifty is now up over 100 points, so looking pretty good. Kalyan Jewellers is really topping the charts this morning, up 5.5%. Manishi, good morning. The space to be in over the last many days has been metals, and even this morning, almost all metal stocks are up in the green. JSW Steel has reported a 20% growth in their volumes, and now with China reopening, there is perhaps a sentiment boost there as well. Is this a space that is good enough for long-term investors to generate alpha returns this year?
I would think it's perhaps better for short-term investors. We think that the metal space, which has been, the China reopening has been possibly the biggest sentiment booster as far as the industrial metals are concerned, rightfully so. But at the same time, if you're facing a situation of global recession, and we are subscribers to that point of view, particularly in the developed markets, then it's difficult to see how this metal space can perform over a longer term. I think it's kind of fits the bill exactly in in a different or opposite direction. It's perhaps a better bet for short-term investors over the next couple of quarters or so. But over the longer term, we would rather remain selective and a bit cautious on the metal space.
Okay, all right. Hi, Manishi. Good morning. I think the last time we chatted, you suggested that India you'll have downgraded to neutral, while China you'll be a little bit more bullish on that. Still hold on to that, right? That's a tactical play?
Absolutely. So, on 10th of December, we published our Outlook 2023 report, and the biggest call possibly there was downgrading India to neutral and upgrading China to an overweight. There were two possible reasons behind that. Number one, we clearly believed that the reopening of China, even though that would be a sort of a tortuous path, because we have seen the daily infection numbers going up there. But at the same time, it is not only a big sentiment booster as far as Chinese consumption goes, it will actually lead to possibly even the consumption in the consumer discretionary space, the numbers turning better, and also earnings estimates reviving in e-commerce, internet, and consumer discretionaries. And that's a really big chunk as far as Chinese equity market is concerned. So that was one of the strongest reasons. And at the same time, we also thought that this sell China, buy India trade, which the foreign investors had engaged in over much of 2022, had actually led India to become relatively expensive. In fact, if one looks at relative valuations, India was at a huge premium, almost 2 standard deviations higher than the rest of Asia. So those are the two reasons why we made that switch at that point of time. The valuation argument has possibly been diluted a bit because over the last 1 month, India has underperformed slightly. So the valuation premium that it enjoyed has declined slightly. But we don't think that that it's at the end of the road at this point of time. We personally think that this valuation correction has a little more room to go.
How are you feeling about the IT stocks now? We kickstart earnings, and this time, I guess, post HCL Tech's mid-quarter, outlook downgrade. The expectations are also low for the sector. But at any point, would you look to buy?
As far as the tech universe is concerned, IT services in India, we actually reduced our position quite significantly in that December churning that we did. The IT services space, after a downturn in the first half of 2022, did reasonably well in the second half. And we think there was a reason behind it. The investor base was actually equating the North Asian semiconductors and chips with the Indian IT service companies. But the Indian IT service companies were actually winners. They were winning large orders from the developed market customers or clients. But we think that after the stocks went up about 20 to 30%, the valuation didn't quite justify, the kind of a downturn or a slowdown in order flow that we could see in a recessionary year. So that was the reason why we downgraded the IT service sector in India, taking out some of the frontline stocks. We still have a presence there, but we think that investors should be a bit cautious on that space, at least in the first half of this year.
Right, Manishi, what about the auto stocks? We've just got the December numbers, and there was some skittishness in the numbers. CV cycle appears still to be on a strong footing, but otherwise there were pockets of worry. How do you approach the space? Y'all were pretty bullish, I think, on the four-wheeler space, right?
That's right. So, in the autos sector, as you correctly mentioned, we are quite positive on the four-wheeler space. What we are seeing here is the classic case of what we call affluent consumption. In fact, that's one of our big themes in India. We are seeing a relatively stronger sales momentum in the four-wheelers, and that too in the upper end of four-wheeler category compared to the two-wheelers. Within the four-wheelers, we would obviously be siding with the market leaders, the players who have a very strong market presence and a distribution reach, and therefore the kind of companies who have very strong pricing power going forward. In fact, in our entire stock selection theme, this element of pricing power, this element of above normal return generation, where return on capital is significantly higher than cost of capital, this is a theme that keeps coming back repeatedly. And even within the auto space, we would stick to that theme for now.
In consumption, what are your thoughts? Because, we have a chat lined up with Godrej consumers in a while from now, and that the entire sector has seen a slowdown in growth because of rural consumption being quite weak, a slowdown post the festive season. If you have positions here, if you have investments here, do you churn out or do you sort of buy into the dip?
We already did that. When you use that phrase, churning out, we actually did that in our early December rebalancing of the Asian model portfolio. We moved out entirely of the Indian consumer staple space. And the reasons were similar to what you talked about just now. Continued weakness in rural consumption, some degree of input cost increase, even though the raw material prices, the soft commodity prices have declined a bit. The depreciation of currencies, Indian and other emerging market currencies in the second half of 2022 could lead to another round of input cost increases to the consumer staples companies, which we think many of them would find difficult to pass on to the consumers. So yes, coming back to your original question, we don't have any presence in the consumer staple space in India in our Asian model portfolio.
Let me just quickly highlight, Manishi, stay with us, a few names which have come back into the mix. By the way, the markets are at the day's high, 152 points, 150 points, 18,010 is where we are at. Look at Adani Wilmar, right? It's up, it's the top gaining name with the most volumes at this point in the day. Nowhere when we started Adani Wilmar, but that's moved up very nicely. Sigachi is up 7%, is a number 2 space in terms of volume-led gains. Kalyan Jewellers was up, but it's up a little bit more, 4.5%. GIC RE is coming up with a 3% gain. HG Infra, it's got volumes. It's 7% higher, and it's within the top 5 sort of volume-led gainers today, at least right now. So lots of newer names coming into the mix. Subex Limited is up about 3.5%. Craftsman Auto has done extremely well. So that's another 4% higher. Stocks at about 36.50 right now. Surya Roshni is coming up with about 3.5% gain. Market breadth still very, very steady, by the way. No real shakeout. 6:1 is advances to declines ratio at this point in time. Titan is still a little subdued. It's down about 2% or so. There are stocks lower, but nothing. It's not a big list backed by volumes or anything for now. Manishi, any kind of sort of non-consensus calls at BNP that you're putting out for 23?
Well, as far as our Asian exposures are concerned, there are 2 or 3 main themes that we're playing. The first of these is the Asian reopening theme. And even though the biggest participant here is China, there are ramifications of that into Southeast Asia and other parts of North Asia as well. The second important theme, and this is allied to the first theme, is, of course, therefore, a consumption revival. And this is also more so in North Asia. As far as India is concerned, we are focused on the private sector banks in autos, particularly 4-wheelers, as we talked about. Selective oil and gas plays, in fact, even not just the pure plays, but also the large conglomerate. And finally, healthcare. I think healthcare has been a relatively new entrant in our model portfolio, where we like both the frontline pharmaceutical and the hospitals space. I think as a consequence of the relatively better performance of the healthcare sector in the second half of this year, we have seen some investor pushback on that sector, but we're still sticking to that outlook. But I don't see too much of a disagreement in any of our sector picks, which would possibly make me characterize them as very deeply non-consensus.
Thanks so much, Manishi, for stopping by and filling us in with your thoughts. Looking forward to chatting up with you, in the next couple of weeks, and wishing you a good 2023. By the way, just keep an eye on the markets. We've seen a good recovery. We're at the high point of the day, as we pointed out earlier today. We got that gap up of around 130, 140 points. It will make things tricky. Luckily, we started off with a gain of around 80-90 points odd, and then we saw a bit of a downtick, and that downtick has got bought into. As we speak, the Nifty is 95 points higher than the lows of the day. So that's pretty good news. And keep in mind, the Nifty Bank is underperforming yet again. It's up only around 0.5%. That could be the one that will swing things around. For the time being, the other pillar is doing well. That's the IT index is doing very, very strong. And talking about IT, well, TCS, they'll be reporting